This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast. It's that time of week again. Another episode of the Three Wise Monkeys podcast is here. My name's Andrew Page, founder of strawman.com. And as always, I am joined by my good friends, Claude Walker from Ethical Equities.
It's been a long day.
And Matt Joss from mattjoss.com.
Hey, thanks, Andrew. Happy to be here.
Guys, you know what? I think we had a really good idea last week was let's just limit the conversation to two companies. We might actually come in under an hour, which would be great. So, Matt, what are those two companies that we're going to talk about?
The two companies we're going to talk about today. The first one is Nanosonics, a company that the two gentlemen sitting beside me own, I believe.
Mm-hmm. I do own shares.
They do own shares, so we'll talk about that one. And then the next one is one that's been requested by listeners, a very hot stock.
Multiple listeners.
Which is AfterPay. So, yeah, very interesting kind of battleground stock. We know smart people on both sides of that one. So, yeah,
that is a really, really interesting company. But Nanosonics is the one we're going to kick off here today. As we always say, as Matt's just indicated, in fact, both Claude and I are shareholders. We're talking our book here. So please treat what we say with a high degree of skepticism and do your best to, I guess, view the other side of that thesis, because we could well be wrong. And
always
in fact,
a good call.
If you think we are wrong, we'd love you to jump onto Strawman. Well, I'd love you to jump onto Strawman and tell me exactly why you think I'm wrong. But let's start at the beginning, Mr. Walker. What on earth does Nanosonics do? Pretty cool company name, right?
Oh, thanks for the great question.
It was a good question.
I think it's good.
So Nanosonics makes a device called the Trophon EPR. This
Another cool name.
Is designed to solve age-old problem in hospitals, which is the cross-infection of different patients. In particular, the issue that they're looking at is the use of ultrasound probes. If you're using internal examinations of with ultrasound probes, you're obviously getting a lot of bacteria on those probes, even if you do some sort of basic precautions, like, for example, they have these sort of plastic sheaths you can put on them. But a whole range of studies found that there would be lots of different bacteria even after these ultrasound probes were supposedly clean. Among other things, this would lead to the transmission of HPV virus between women through hospitals. But there's a whole range of hospital-acquired infections you can get through ultrasound probes, and the main way that we sterilize them is not as effective as the nanonebulant particles that the Trophon EPR uses.
These guys know how to name things.
I was just going to say nanonebulant. I love it. So this is the highest standard of sterilization that you can achieve with these things. These devices, I added a little bit more to that. They're very sensitive, expensive devices. So, you can't just chuck them in a kiln.
Wait, what?
Chuck it in a kiln.
I've been putting my ultrasound devices in the kiln all my life. Now
I clean everything in my kiln.
These young people.
I'm going to edit that part out.
What? You can't edit that out.
I'm editing that out.
Keeping it in.
No, I forgot my microbiology. You can't just throw it into an autoclave, which is a high pressure, high temperature environment. You can, as you say, they can wipe it down with some various chemicals and that. That is very dangerous. There's a lot of human error involved. So this is regarded as the highest standard. So not only is it there are good, health reasons to do these kind of stuff, but there's a lot of legal reasons as well. Hospital administrators aren't exactly thrilled with the idea of, their hospital or institution being responsible for transmitting any kind of nasty disease.
So just to clarify, what do these guys actually sell?
So they actually sell a unit called the Trophon. Mm-hmm. And it's like a little mini bar fridge, I suppose.
Okay, so about that size.
A little bit smaller, and you hang the probe in that. You press a button. It takes 7 minutes, and it sterilizes it to a very, very high degree.
And so the technology that it uses here is basically something that makes nanoparticles of the same disinfectant that you would otherwise use. But this disinfectant is supplied through little canisters that fit into the machine, and they are the main consumable product. And that is where the interest lies, because once they've sold these units, the customers need to keep on buying the consumable products. Now, there are a few other kinds of consumable products associated with documentation, so that it makes it easier for hospitals to have the systems in place to check that all of the probes have been sterilized. But the main one is just this sort of solution that goes into the machine and then gets nano-nebulized.
Nano-nebulization, almost complete.
Breaking up the chemical into those sort of nanoparticles then just basically allows it to be so much more effective. So it is quite smart. There is some innovation in there as well, which is also what I like to see when I invest in a company.
Yeah,
Very
so
nice.
it's a really good product. It's doing a lot of good. But the important thing for investors, I suppose, is anyone buying the damn thing? And the short answer is yes. These guys have a global installed base of almost in fact, probably by now as I speak, more than 18,000 units globally. A whole bunch of those, in fact, the majority of those in the United States. And interestingly enough, they've barely touched on the available market opportunity. Just think of the number of ultrasound procedures that are done around the world. The vast majority of them are not using this device.
Well, I wouldn't quite say barely touched on. They've got a significant portion of the US market.
They've got 39% of the North American market.
Yeah, so that's more than barely touched.
15% of the global market, my friend. 2% of Europe and Middle East.
39%. That's like a two-finger slap. That's a touch, a firm touch.
Well, look,
I haven't heard that expression before.
I think we can
Is that an
agree.
Australian expression?
No,
I like it.
I made it up.
Anyway, so a very big installed base, and that
Yep.
installed base has been growing incredibly strongly as well. And no surprise, you will actually see the revenues and the financials of the business also performing very well too.
Can I just touch on why we like this business model? So I think you mentioned the consumables, but to me, I guess the reason to kind of unpack that is the razor and blade model, isn't it? So you go to buy a Gillette razor and you think, wow, this razor is so cheap. It only costs a couple of dollars. And you're like, oh, that's great. But then they lock you into the
I mean, I paid $20 the other day for like 4 blades.
Yeah, see,
Each blade had 12 blades on it, to be fair, but
100%.
still.
It's like printers, right?
Yep.
The printer is almost free. Like they basically give it away. And then the printer cartridges, like the ink of a printer cartridge is worth more than like gold or whatever else.
And they can do it too because you're kind of locked in. What
You're
else
locked in.
as Claude said, there's no other sort of capsule that's going to fit here. So they control this, and they obviously charge very high margins on that as well. One thing I should mention on this as well, which is very interesting, a little bit of a growth driver. Previously in North America, they had a distribution agreement with GE, and GE would sort of sell the units and also sell the consumables as well. Starting from next year, it's actually going to be Nanosonics is going to directly supply that. So they're going to get a much bigger margin. They're cutting out a bit of a middleman there as well, which is going to be a very nice kick to earnings as well. So it's done all of that kind of stuff, Claude. And I think the other thing, just while we're on the financials quickly, we have to mention, which is always a very appealing characteristic to my mind as well, is that the balance sheet is super strong. They've got just shy of 70 million Australian dollars on the balance sheet, 0 debt. So this is an extraordinary cash pile. And I think, look, you've always got to take this with a grain of salt, but I think it's not unreasonable to say that this business is about as close as it comes to recession-proof. The number of disinfection cycles that are done around the world aren't necessarily going to be that sensitive to economic conditions. Moreover, because of that very vast geographic diversity as well. If Australia gets into a bit of trouble, there's North America and vice versa, etc. So that's another very nice thing as well.
All right.
Anything
Well,
else
let
you'd
me
add
get
to this
a
before-
word in edgeways.
Sorry,
That's a good.
sorry for boring you.
No. We know you love the company, and if I recall correctly, do you still have some superannuation invest in it?
I got direct and super.
Yeah, nice. Yeah, so I think it was a good one for because it was an ASX 200 stock. You could actually buy shares
I've
through
got an
your
Australian super
Yeah,
account, so
yeah.
I'm restricted to the
And
ASX 300.
And when did you actually buy shares in that company?
Originally 90 cents personally, but the super account was 230. I want to say.
Yeah, so you've definitely done better out of it than I have. But talking about the more important numbers, like you've given us great broad brushstrokes of why you're excited about it.
Oh,
You've
I could
held
go
it-
on, my
Yeah,
friend.
I know. Well,
Oh, I
we'll
could
go
go
back
on.
to you. Don't worry. But I just want to zoom in onto the numbers a little closer. When you recently wrote up the results for Ethical Equities, thank you for that.
Pleasure.
You estimated that it looks like each trophon unit probably generates about 2.2k a year
US.
in sort of consumable sales.
They used to actually disclose that. They don't anymore. I think it is a little bit higher. So let's call it 2,500.
Okay, well, I'm going to go with 2.2 for now,
Sure.
but there's upside there. We'll
Sure.
note it. And also, yes, they've always made it not too easy to figure that out. We've had to do a bit of detective work in the past, I know, to get a good...
Ballpark figure.
But I think it probably changes and different from over time, obviously. It also is distorted by the fact that they're changing the way that they're selling
yes.
And so this is a big part of the story as well. The share price has come down a bit. The revenue growth has slowed, in part because they're increasingly selling their units on, I guess, more either a rental model or a sort of model whereby they don't get the big capital sale as much, but they get a higher amount for the consumables.
Subscription model based. They call it an NES.
More like they're
equipment.
giving away the actual razor, but then they're selling the blades for even more.
And over the lifetime, so these things tend to last 5 to 7 years. Over the lifetime, it ends up generating the same amount of cash. It's just spread out further.
Yeah, actually, if I recall correctly, in a conference call, I was under the impression that actually it generates more cash this way.
You're right, a little bit more. Yep.
But so anyway, run rating at the moment, you said about 18,000 units.
Yep.
If we use the 2.2 number, that gets us to about 40 million or so on what you could sort of call recurring, high margin recurring sales.
Yep.
Now, what we do know is that those sales will become even more high margin once the GE distribution deal
North
flips
America.
over.
Yep.
Yeah.
Yep.
So that's gonna boost the profit. It's already profitable. Based on like the last 5 halves, it's made a small profit.
Yep.
It hasn't been going up regularly. It's a profit before tax.
Mm-hmm.
And it's when do you think we're going to start really? When can we expect to start really seeing profits here? Because the company has made no bones about the fact that it's focused on growth. It's spending more and more on new product developments. We don't know how they're going to go.
Yep.
We don't even really know what those new products are. We've just got a few
Yep.
hints.
Mm-hmm.
Trophon 2's coming out. That should help in the short term. It could be
I
some
think it's
good results.
actually been released already.
Yeah, it
It's
is.
starting
It
to
is.
be rolled out. Yep.
So there might be some issues in the first half related to changing over, but
Yep.
then by the second half of 2019, do you think it's fair to say we expect to see a pretty strong profit result by then? And then we're going to go into that's when the first half of 2020 is the first half where we get the new GE deal.
Yep.
Is it fair to say...
Financial year 20.
Yeah.
Yeah, 20. Yep.
So is it fair to say in that half, which will be, I guess, the second half of 2019 calendar, that should be a really profitable half?
I think so. And it's one of these things. To be honest with you, Claude, I'm not big on sort of going half on half or a year or so. I think obviously you've got to have a view on that. But I've actually approached this in a fairly broad way. So the other part of what you mentioned there, the consumables part, which is great. They also do a capital sale on the device itself in North America. That varies anywhere between they don't again disclose it exactly, but I think it's between $8,000 and $10,000 US. They've been selling about 3,500 units per year. They've guided that that's basically going to be the same. So here's how I've done it. I've just thumbsucked this and say, let's just say that they continue to sell about the same amount of units for the next few years, right?
I'm starting to get a feel for why Matt doesn't own it now. He's like, when Andrew's like, I've just thumbsucked it, and Matt's like just
You lost me.
frowning.
Sorry, I've got a spreadsheet with 12 decimal places. But I think it really makes sense. So if you say that they're going to sell about 3,500 units, that's more than 10,000 extra units in their fleet in another 3 years or so. Mm-hmm. So that means they're going to have 28,000 units. You can multiply that by the average consumables. You're going to get about 90 million Australian dollars in consumables revenue right there. You think it's probably reasonable to sort of say $40 million in capital sales. So you've got a business in 3 years will have a revenue, I think, this is not factoring in any new product sales or any too much of a margin uplift or anything like that kind of stuff. And by the way, falling Aussie dollar helps these guys as well. So a lot of this was modeled when the Aussie dollar was a little bit higher.
So give us the number.
Cut to the chase, Andrew.
We're in the weeds.
Look again. I don't get too specific with these. I think around sort of like the high $2-3 is what I would consider a very reasonable price. One of the big criticisms.
That's like it's $3 now.
Yeah.
Yeah.
Yeah. What's your point?
We're trying to. I thought you were really excited that it's going to go up.
So you're saying it's fairly valued?
No. I'm saying it's.
You're saying
I'm saying it's a phenomenal company. I'm saying it's a
getting to
phenomenal
that.
company. I'm saying it's a conservative estimate. I think when you have a very, very strong company with a very, good management team in place, long growth, where you don't want to overthink that, and get too cocksure with your intrinsic value calculation. I am playing this for the long term. So yeah, I put it in my super account. I expect to be a shareholder in Nanosonics, barring any major blow-ups in another 10 years time or so.
What was you was leading up to saying what you thought the revenue would be in like 3 years or so?
Yeah, I think it's not impossible to sort of have a business whose revenue is double what it is now. So what a lot of the criticisms will be, sort of, people will look at these, again, it's any criticism of a growth company is, the PE is really high. And it's like, yes, it is, but the growth is extraordinarily strong. And you don't have to go out 20 years before it gets exciting. And the other thing that I tend to notice in these kinds of businesses as well is that when you've got some really good sales momentum, that tends to stick around for a little bit as well. I mean, it shows you that there's a legitimate market demand. And generally speaking, those sales as this becomes more the standard in the industry. I mean, the first sales are really, really hard. It gets a lot easier from there as well. So I don't think I'm baked in a lot of blue sky with all of this kind of stuff to get to a reasonable price.
Yeah. I guess I don't have any dispute with any of that. I think that what kept me away was that it's going to take a while, as Claude explained in quite good detail there, before that growth really ramps as a result of that change. And to me, it was like, it's trading on about 15 times sales right now. Yeah. I think like based on analyst estimates, maybe 50 times 2020 earnings. Mm-hmm. So I just think I'm hoping, I don't own shares. Like,
wait till we start talking about AfterPay.
I'm hoping that the market bidders on it, so that it comes down to like 5 times sales, and I can buy it.
Matt's hoping for a share price crash,
and then but that's not crazy for it to trade on 5 times sales. Like a lot of growing companies trade on that. It's quite a nice place to buy, and then obviously then you get the ramp that comes in a bit later. So, but obviously it hasn't crashed. So I haven't owned it for a while, and it's gone up quite a bit since your last big buy. So very well done to you.
So I don't want to do any victory laps. Just look, I mean, that's been in a bull market, and this thing can reverse tomorrow. It got to 380 or something pretty crazy as well.
Before we do sort of move on, like it is an extremely high PE right now, but I don't think 5 times sales is going to be on the card, because basically the company's operating at break even and has done for quite some time whilst investing a lot in future growth. There are a lot of levers that it could pull to make a bigger profit. The most obvious of those, which I do not think it will do, is to just take its spending on new products back to where it was a few years ago. And suddenly, its PE would come down from 150 to 70, which is not...
They're spending $10 million a year on R&D. Even 3 years ago, that was half of that amount.
What do you think about the competitors? So they don't have the whole market, and some of them they're only modest share?
Yeah, it's a really good point. Well, I have not been able to find any competitor that looks threatening. And the competition really is just the status quo, which is just the standard disinfection techniques. So it's not as though the drive is really coming again from the hospital administration level more than anything else. But the clinicians love it as well, because you chuck it in, you press a button, you walk away and you do something else, as opposed to handling...
Set it and forget it.
Set and forget. I mean,
and also that stuff that someone had to put their hands in,
disinfecting things. You're playing with some pretty dangerous chemicals. And
do you have experience disinfecting things? Is this from the science days? Is this
we did. Well, when you're doing microbiology, you're studying germs, and so you do a lot of that kind of stuff.
Did you explain it at a bar if a girl asked what you're doing? Did you say I study germs?
No, I didn't, because I didn't think it would help my chances.
No,
with
it's
ladies.
Good move.
I had no luck anyway, so I probably didn't make any difference. Guys, let's...
No. So the one thing I wanted to say on this is what I watched for with Nanosonics is when... There's a lot of people think it's overvalued, but I actually think it has a lot of levers it can pull, and come a certain time, as we said, this first half of 2020, it will have a stronger profit result and it won't look so expensive. In the meantime, there's been a lot of short sellers targeting the stock now. It's not heavily shorted right now. It's about 8.5% shorted, and the share price is about $3. If I saw that share price drop around to a more attractive valuation, say below 250, and at the same time, you see that short interest's rising. Now, for those that may not know, short selling is where someone essentially borrows the shares, sells them, and then hopes to buy them back lower. But the more people you have doing this, the more people have to one day buy back shares. Now, typically, a good target for short sellers is a company that's going to go bankrupt. It's going to run out of money. It's going to go to zero, and it will really just hit the absolute skids. But Nanosonics has 70 million in cash. It's got gross profits of 45 million. Of that 45 million brings in gross profits. Half of it goes on salaries. I beg your pardon. Half of it goes on marketing and selling, and then a quarter of it almost goes on R&D. That is something they can flex if they want. They're actually increasing.
I don't think they should, but yeah,
no, neither.
Yep.
But they can. Like this company is not going to get distressed when it is operating at break even, has tons of cash, and is also spending a lot of that cash on the next big thing. Yeah. So the only way the share price can go down is sentiment and people losing hope, as Matt was sort of
which is always a precarious short thesis.
Exactly. But it's going to turn at some point as well. Like at some point, the Matts of this world will say, "Oh, actually, I will buy it at 5 times sales," and then that's those. As those people pile in, the shorts have nothing to gain.
Back up the truck.
And I worked very hard. I still cannot find a coherent short thesis. That it's like something real rot there. I still wonder if it's some sort of arbitrage or it's a hedge against something else.
Yeah, so, I've really searched for that bear thesis. I can't find a good one. So other than valuation.
So if anyone's listening, they've got one. Maybe message, huh?
So unlike Andrew, I have sold a little bit of Nanosonics when it reached quite high prices actually not that long ago. But certainly when it gets to what I consider, an attractive valuation with a high level of short interest, I'm definitely willing to buy again, and I would also be happy to do that. I don't know if we'll ever get 5 times sales, but certainly there is a price.
Yeah. These times can come.
Yeah, look, if it is at 5 times sales, Matt's not the only person that will be buying it that way.
And maybe at 7.5 or 8, I'll take a look. So guys, I think that we covered that stock pretty well. Another stock which has a probably even bigger battle with shorts and longs is AfterPay. So Claude, do you want to give us a rundown on AfterPay? What it does?
You're a millennial, aren't you, Claude?
I am indeed an adult under 40.
Yeah.
He's a millennial under 40.
Enough of these slurs.
Yeah. I'm close.
Millennials big, man. It's a big group.
Oh, right.
Yeah. We're under 40.
Good for you.
AfterPay is like literally, it's just, everybody knows anyway. It's just
I think most people know.
It's just a payment method. Like, it's just exactly like you would use your credit card, except instead of putting your credit card into PayPal or into surfstitch.com, you put your credit card into AfterPay.
I take issue straight away with that. I take issue. It's if AfterPay management here, they would go, "How very dare you, sir?"
Oh, come on! And
it
just
is
let
not
me
a
say
credit
my bit,
card.
and then you can trash it. Anyway, so it's I said you put your card in, or you put your debit card in, or your sister's debit card in, because you're probably like 16 and you're using it to buy alcohol. True story. It was in the papers.
Okay, so it's a payment method where
anyway,
you pay.
and then the payments come out over like 6 weeks, and if your sister doesn't have the money in her bank account, then she gets a fee every time she fails to pay it. But if she does, then she gets to spread her payments over 6 weeks. And the only way that would be useful is if she didn't have the money in this week, but she's going to get paid over the next 6 weeks and can afford it.
Can you give a non-millennial description, Matthew?
Yeah, so...
No, he can't. He's also an adult under 40.
I know.
This is true.
Damn it.
So it's a payment method that you pay for it and then you make fortnightly installments for equal fortnightly installments.
It's lay-by.
It's lay-by. It's reverse lay-by, actually, because you get the goods up front.
Mm-hmm. The key point is that it costs you nothing. So there's no interest in this whatsoever. In fact, AfterPay make their money from the retailer, from the merchant, who will pay anywhere between Again, they don't.
Wait, so they don't get any late fees at all?
Wait a second, I'm not done. They pay between 4 and 6%. Now, why would the retailer do that? Because supposedly, and in fact, the evidence seems to be quite strong on this, they get more sales out of it. So they've got a big incentive to do it.
It's like a race to the bottom, because like one retailer has it, so then another retailer has to get it, and they all have it, and meanwhile AfterPay is like, I get 6%
I wanted
of your
to get
sales.
to the network effect is massive.
But then all the retailers
guys.
just put the price up by 6%, and you're sort of back to where you started.
That was my next point. I think there's no free lunch right out there in finance, and I would think that it's some way somehow there's this cost is being built into it somehow. But the point is, it facilitates extra sales. People have been going gangbusters for it. These guys have just absolutely exploded. They were a $165 million company when they listed. Now they're worth $2.3 billion, I want to say. Their revenue is growing at an incredible rate. Unbelievable. Kim Kardashian tweeted out today that her new fragrance is available on Afterpay, and she named it using an account, and shares were up 8% on the basis of that alone.
Was that today?
That was today.
God, that's a buy signal.
We're recording
Thanks. Forget your thumb suck. That's enough.
Kim
Kardashian.
That is all
I
you
approve
need
this
to know.
this measure, the Kim Kardashian.
The
measure.
Kardashian. So look, I mean, we have butchered this so terribly. We are meandering all over the place. But let's bring us back on track. It's a new payment platform. It's incredibly popular. It's had phenomenal success in Australia. I think the majority of online sales in Australia are now done here. Very, very sexy. Very, very exciting. They decided, like a lot of Australian success stories, hey, let's go overseas and do that there.
The best part of that meandering explanation is that I'm pretty sure 90% of the people already know what it is.
Yeah, that's true. It's one of them we don't understand.
For anyone who's still
but
listening,
the business model, that 5% thing people might miss. That's how they make their money.
Yeah, that's
right?
key.
That's
And the late
late
fees.
fees.
and apparently about 25% of their revenues last year were in late fees alone.
Sweet. Yeah,
so it's quite a big amount.
So yes, the US.
The
Let's bring it back.
US
Yeah.
is. I actually wrote it down, but
So I believe
find it in my
they've signed
notes.
up, the customers have already signed up. They have about 900 retailers in the US, and the addressable potential kind of gross transaction volume from them is actually bigger, just the retailers they've signed up, if they had it all, is bigger than the entire online apparel, the entire apparel market in Australia. I think that's what they said.
The US market, I found it, 15 times the size of the Aussie market. They're also launching into the UK, which is, I think, the third largest retail market in the world.
So I think we should dig into that business model thing, because that's why Claude and I both looked at it very closely. I won't speak for Claude, but for me, I dug into the business model very deeply, quite early in the story. And at that point, they were charging around 2.8% to the merchants, and they were having losses from late payments, which effectively meant it didn't matter how much they grew, they were never going to be profitable, in my view, or they'd need to be many billions just to even.
I remember looking at those numbers with you at the same time. We spoke to the CEO, who seemed quite nice, but it didn't quite allay my concerns about that either.
Yeah. So, but what's changed is they've increased how much they're charging quite a lot.
They have pricing power.
They have pricing power. So taking that 2.8% up to 4% on average last year, and as Andrew said,
I've
for
heard
some of them,
newer ones, it's up to 7%.
Up to
Holy
7, there
moly.
you go.
I read that
So
today.
so on average last year I think it was 4, but it's been increasing in Australia. I think in the US it's a bit lower because it's a new market and so forth. But that is the difference. That's been the
that's what's
key
made it so much better.
difference, that it's the unit economics
Can I
actually become quite attractive.
dig into that, because it's a really interesting model. So what it is, let's say that they make it nice and easy. They borrow $100 off a bank, and they're probably paying 6-7% on that. Now they're only charging, let's call it 4% on that. The reason that they're able to make such great money is that because this credit is issued over such an extraordinarily short period of time, 8 weeks or so.
6 weeks.
6 weeks. Split the difference, 7 weeks. And
It's not, because anyway.
All right, guys.
Doesn't matter.
The legislation
is,
that the loophole that they have sailed through in terms of not having to do credit checks and all that sort of stuff is 6 weeks.
Okay, so 6 weeks. And so you can
sure.
take that $100 and you can lend it out multiple times throughout the year. So you're getting that, you have to annualize that all out. So they're borrowing money at a certain rate, but they're lending that out on an annualized basis at a much, much higher rate.
Yeah, they turn over the capital. And, we baked that in when we looked at it back then.
You did, yeah.
The difference is how much that upside.
That's a good insight. And
it is a good insight, yeah. I think a lot of it's like the first comeback that you hear from people who talk about the risk of their capital, is how fast they can turn it over.
yeah.
Is there a risk that their lenders sort of walk away themselves if they were to get into trouble?
Yeah, absolutely. So that's the big. It's a very capital hungry business because they're taking all the risk of those payments, right? There's a reason that it's very attractive for all these merchants, is because A, you bring more business, but B, you take all of the credit risk. So
merchant gets the money up front.
And online sales, it's fraud, returns, all this stuff. Well, returns can be part of that, but like just blatant fraud where you get chargebacks is a very big cut. Like it can be up to 0.5%, so that's like a very big loss. And they're taking all that plus all the risk that a credit card company might normally take. So that risk has a value, and that's what they're capturing. But then the funding for all that, as you're saying, needs to continuously happen. So to fund this growth, they have to have hundreds and hundreds of millions of dollars of fresh capital being made available, and that's definitely been the case. It's been possible. The risk that I think we all saw was if that funding dried up at any point, the business could have a heart attack effectively.
Yeah. In terms of the sales that they're actually funding, I think it's expected to be, what, 3 billion or something this year? And
I think it was run rating at 3 billion as of the last quarter.
Right.
So it's going to be much more than that this year.
So they really require a lot of... and look, lenders, they're fair weather friends, right? They'll be there whenever there's good money to be made. But I guess it's a risk that people point out, and it's one that I think we'd be remiss not to discuss, because one thing that you see with these types of businesses is that they do extremely well in the good times, but if things get a little bit tough, they can turn south really quickly.
Yeah, because there's a multiplier effect, right? So things turn south, people stop shopping as much, so you just have a straight downfall in revenue in that sense, but also people stop paying their bills, so you have higher, bad debts, you have less funding available at the same time because no one wants to lend, particularly to the most at-risk part of the value chain. So it's a multiplier effect. All three things start happening against you, and as a share price, obviously your multiple contracts at the same time.
I'm going to throw in the AfterPay retort to that, and so again, I'm just sort of doing the whole devil's advocate thing, but they would say, look, we have extraordinarily rich database of users. We've got extremely good data on all of these kinds of things. There's a law of large numbers that comes. They basically take an actuarial type approach, and they can put some pretty smart and reasonable maths behind all of this to sort of say, yeah, I know there are going to be some people who rig the system. There are going to be some people who don't pay. That's all baked into the model. In fact, the more people use it, the better insights they have, and that's in fact a very strong competitive advantage itself. Not to mention an off-balance sheet asset. I would argue. And so they're getting better and better at managing that. In fact, their net transaction losses have actually been heading down a little bit.
Yeah,
that might just be fortuitous short-term movement, or maybe it's a sign of them being able to very smartly manage that.
That thin margin was what had kept me away originally, but I think that has improved dramatically. I'd say I think I measured the transaction losses slightly differently to the way that they did. Maybe I just take a more conservative approach, but I think generally that is the trend it's been going. So I think that there's truth to that. It's just there's a certain economic scenario like a recession, which we haven't had obviously for almost 30 years. That kind of would give pause for thought. I think a lot of people now are saying don't worry about that because the US is there and the US economy has grown extremely strongly. But obviously there can be a recession in two markets at once, as we've seen.
And it's not as if the US will have a recession at some point, right? So there's the other risk that we need to talk about, which is the one that comes up all the time too, is the regulatory risk. So we know that there's a Senate inquiry into them at the moment. ASIC last year started looking into them well. I believe that report is going to be issued next month or so. And they tend to get lumped in with like the payday lenders and this sort of other financing industry sort of outside the major banks as well. So there's a bit of fear that the regulators might sort of say, listen, you might say that you charge no interest in the rest of it, but there's some pretty damning figures that are out there. Just looking in the AFR today. And this article was talking a bit about a Mozo survey on AfterPay. It did surveyed 1,000 different Australians from different age groups and locations, found that 44% of respondents were using AfterPay to buy necessities like food and furniture. 30% admitted to having concealed their AfterPay spending from a partner or parent, and that a lot of people who use AfterPay have debts elsewhere. And then, in other words, this is something that also needs to be regulated. Do you guys, Claude, you've been quiet for a little bit. Do you see regulatory risk as something to be worried about?
So I don't think that regulatory risk will sort of sink the company now because it's so ingrained that it's sort of like it's walked through the gap. And now, if and most likely when it is more appropriately regulated, it's still established in there. It's still charging its cut from all these retailers. So it'll probably be fine as a business. But from a social perspective, yes, I absolutely do think it should be regulated. Actually, a big part of the reason why I have not owned shares in AfterPay is because I don't feel comfortable with the business model. I look for businesses like Nanosonics that create something that helps people.
That nebulize.
I think that I think it's almost a facetious argument to argue that AfterPay helps people by allowing you to defer payments of like small consumer goods online that you don't really need. It's not really doing you any favor. It's a short-term favor for long-term pain. I think that you often hear shareholders defend the sort of late fee limit by saying, oh, there's a limit on how much they're charged. It's $10. So for a small transaction over, I'm reading from the website here, for each order below $40, a maximum of one $10 late fee may be applied per order. for each order over $40 or above, the total late fees are capped at 25% of the original order or $68, whichever is less. So essentially, if you're talking about somebody who is using it for fairly small transactions and then starts defaulting on those, if they've bought, say, 3 things on AfterPay, they're going to end up paying basically 25% more for those goods.
AfterPay say that 78% of customers have never paid a late fee, which is another way of saying close to a quarter of customers have paid a late fee.
So 20% have, and they're the people that probably really need AfterPay. But let's just unpack this late fee things, because for payday lenders, they are capped, I think it's around 26% a year in terms of what they can charge in interest. But for AfterPay, they're going to charge you 25% of your transaction value in a late fee, and they're going to get that off you as quickly as possible. So it's not 25% in a year and you can pay a year back and you can pay a year later. It's 25% as quickly as we can get it out of your bank account. And the reality is, if you go and look on like the sort of AfterPay Obsession and We Love AfterPay and all of these groups in Facebook, you can see that for some people, they need to find a shop that has AfterPay because they're not going to be able to buy the item otherwise. And what you've done with AfterPay is just like you would with if you got your Amex, you can spend, if you get paid $4,000 a month, you can spend $4,000 on your Amex and then you can pay it off once a month and never pay interest on your Amex. And you've got that $4,000 float that you've just gotten there. And by bringing forward your pay by 1 month at the expense of Amex, that's what people are doing with AfterPay. They're bringing forward their pay by a few weeks, but then they get in this cycle where they keep on needing to use AfterPay for the next thing and the next thing because they've brought forward their pay and they never catch up. And so you could end up defaulting on AfterPay payments several times a year because it's 6 weeks. You know, hypothetically, it's quite possible for 5 times you might pay a 25% penalty 5 times in a year. So
it's a legitimate concern that the regulators have.
Yeah, there's a lot of people that use it responsibly and it's fine, but there's a certain group that could be at risk, just like I guess with any financial lending.
And we don't, and because they're growing so quickly, it's hard to really tell where the profit margin's coming in. But I think that it's quite likely that, if they had to give back all of those late fees, then their share price would be a lot lower.
Yeah. Okay. So, man, we could dig so much further into this.
Can I just drop a stat?
Oh, yeah, please.
Which is just to the point Claude touched on. So in the US, they did a survey of to see how many households would be able to cover an unexpected $1,000 expense.
Yeah, right.
And 61% of American households couldn't cover that from savings.
I wouldn't be surprised if Australia was
$1,000.
at a similar level. Yeah.
I think Australia is much better. So Australia
really?
is the other way. It's like,
okay.
60% or something could cover. But yeah, pretty dire straight. And I guess the pro argument would be that AfterPay might be a better method than other alternatives, but I'll let people decide.
They will say that they reject 30% of transactions. Yeah. They will say that there is debt cannot accrue.
Compared to a payday
they will shut it down. It'll be at a small amount. So there's all. So again, anyone listening to this and who's got AfterPay shares will have a firm view one way or the other. So hopefully,
I think if they have AfterPay shares, they'll have the view that it's a great thing or at least a decent thing. And I don't think it's that bad a thing either. I think that it is hurting some people.
Yeah, I don't doubt that. So for me, I actually look at this and, I know you were talking about before, Matt, that Nanosonics on 15 times sales was pretty crazy.
Yeah.
This is on 25 times sales,
yeah.
So this is and that's now after a 40% fall in share price. So the question that we need to really end on here is, we should have said none of us. Am I correct in saying none of us own AfterPay shares?
None of us currently own.
I wish I did
at
buy
the
them a year ago because they've more than doubled, but I don't. But
Matt's going to run off and buy some now.
I have to admit, after sort of doing a bit of prep today, I'm starting to get a little bit more interested in it because the bull case here, which I don't think is too unreasonable, is the fact that the runway here is massive. They've got such great traction in the US. There's such a long way to run. The UK itself is also big. One of the things that you could quite easily paint a picture of this, that in 5 and 10 years time it is orders of magnitude larger than what it is today. and that really shares really aren't that expensive when you sort of look forward on that basis.
So I guess we're talking about price to sales. The company grew revenue 390% last year.
390%,
and it's already at pretty large revenue scale.
Yep.
So the fact that they're able to keep growing at extremely high rates is why it's so attractive.
And that is likely to
folks.
Continue. I would.
Yeah,
argue.
not at 390% probably, but you know,
Maybe only 100%.
Yeah. And so that's what's attractive. I think the other thing that I touched on what I'd missed before about the margin increasing. The other thing was just how quickly they can grow. So although it's a capital heavy business, it's not capital heavy in terms of the time heavy, I guess, to acquire a customer. So it's a relatively quick and easy integration. And once you integrate, it's an extremely fast ramp because everyone checking out sees this option. Yeah. So that means that you can grow explosively fast, which is something that I hadn't really factored in. I kind of did if it took a couple of years to reach $1 billion, and they reached $3 billion within 2 years. So to me, I'm kind of interested for those reasons, but I really need to understand the risks and kind of model it out. That's just my style. So it's a fairly complicated one to think about. I looked at it a bit on the weekend, so I'm still doing a bit more work on it. But definitely more interested now than when it was at $23. And I think that just tracking how the US entry is going is pretty interesting.
And I think if you are a shareholder, you don't need us to tell you this, but you are a long-term bull. I think that what you just have to acknowledge and accept and make peace with is this going to be a crazy ride. We've seen days you sort of look in the morning and the thing's up 5%, and you go and check in the afternoon and it's down 6%. It is just super
when something's
volatile.
growing. I think Matt's touched on this before about how difficult it is for us to understand exponential growth. I think when something is growing so quickly and it's not profitable, there are so many unnowns that you just see this volatility as a byproduct of the fact that it is hard to value. And it's so sentiment takes a lot of control. For what it's worth, I think it looks pretty decent. I would, if I had to choose either to be long or short it, I'd be long it. I think that it probably looks pretty good.
Yeah, I'd say the same. I wouldn't be shorting it.
Yeah,
no way.
I might sit this one out, safe in the knowledge that fund managers I invest with have got their eye on it, simply because I have doubts. Because I don't feel great about it. I know myself, and everyone should have a look at themselves and their own strengths and weaknesses as an investor. One feature of my investing is that for a stock that I feel great about, like Pro Medicus or Nanosonics in terms of what they do, I'm quite capable of holding through the ups and downs without it bothering me. If I have second guesses about the impact that they're having on the world, I don't have the fortitude to hold when it seems like my thesis might be wrong or the share price is going down, and those factors come in as well. It's just too much for me. So yeah, it's usually better for me to sit these ones out.
I'm really glad that we only chose to talk about two companies. I'm just going to put that out there because, God help us if we decided to do three. Gents, as always, it's been a great privilege and very insightful. Thank you so much for your time.
You're welcome.
Thank you so much.
Thank you for having us, Andrew.
As always, remember that we appreciate a bit of social media love, a like or two. Or, do you like on iTunes? I don't use iTunes. Do you like on iTunes?
I think you could leave us a rating, a 5-star rating, and a little review would be great.
Really what we need. We need is, but
Spot
also
the millennials.
We got our last. I don't think many of our listeners use SoundCloud, but I use it. It's great. You can like things on SoundCloud.
That's right. You can indeed. So please do that as well. As always, we'd love to hear your comments, suggestions, feedback as well. You can always reach us on Twitter if you would like to do so. Claude, your Twitter handle is?
Claude D. Walker.
Claude D. Walker. Nice. Matthew?
At Matt Joss.
Nice. JOASS.
Correct.
And I'm at Sage Simeon. And as we mentioned last week...
have we received an email yet?
I don't know. Does anyone?
We have received an email.
Yes.
Matt checks it. Okay.
Can you share?
It was an email asking about some of the nitty-gritty details of PushPay. So I responded a little, but we could touch on that on a future.
I'd be interested in your response.
Yeah,
sure.
okay.
Get into those nitty-gritty.
And that email address is...
3 Wise Monkeys podcast.
Is that like
gmail.com?
the
And that's all.
number 3?
No, it's all letters. THREE Wise Monkeys podcast at gmail.com. Andrew, do you want to play us out? Do we need anything more?
By this stage, if my editing's any good, the music is already playing and people have long since switched off.
Right.
But guys, thank you very much, and we will be back next week with another episode of the 3 Wise
Thanks for
Monkeys.
listening.
Thank you.
Bye-bye.
Boom, boom. Yeah, from the top of my dome. Rock-a-muck-a-dome.
Testing.
Yeah, with the freestyler bump. Rock-a-muck-a-dome, boom, boom.